Today's guest is Gregg Robins, founder of Robbins Advising, a company that is focused on business and financial advice for families, institutions, and startups. Gregg holds a doctorate from Oxford University and over the years has been teaching executive MBAs in leading business schools, including New York University Stern School of Business and New Economic School in Moscow. Gregg has over 20 years of experience under his belt. During these years, Gregg held executive roles in wealth management and financial services at Citigroup, UBP, and UBS. Today, Gregg divides his time between advising clients and working closely with trusted partners, notably Global Gate, on investments in real estate, private equity, and debt. Welcome to the podcast, Gregg.
Thank you, Vadim. Great to be with you today.
So we have a lot to cover today, and thank you so much for doing this. Last time we saw each other was in the beginning of January at the Russian Wealth Advisors Forum in Zurich, at which Christian Gadeker, head of research of Julius Baer, said that we managed to avoid the global financial crisis this year. But since then, a lot has happened, and I don't think anyone could ever predict such outcome. You're based in Geneva, Switzerland. How is COVID-19 quarantine like in Geneva?
Well, first, before I answer that, let me just say to everybody that's listening, thanks for taking time to visit today. I hope we can talk about things that will be of interest and impart some knowledge and some concepts. And I would also say, my well wishes to everybody listening for yourselves, your families, to stay safe and stay well and stay sane in these times. In terms of Geneva, I have to say, on balance, we're doing pretty well here. Like many places, or most places, we are on a shutdown. Everything is closed apart from supermarkets and pharmacies. But unlike some of our neighbors, for example, in France and in Italy, we do have the ability to go outside. We have the ability to walk, to exercise, and to enjoy what has been very, very nice weather here. Personally, I've discovered, I used to be a very serious tennis player. And so I found a wall in the park next door. And so I'm going out and hitting balls against the wall, which somebody told me that Roger Federer is doing as well here in Switzerland and in other parts. So it's nice to hear. So all told, I think we're doing the best we can. And I think I mentioned to you earlier in a conversation that the highlight of every day for us is at 9 p.m. in the evening when we all go on our balconies and we applaud the health workers who are so brave and so selfless in putting their lives at risk to help others and to save people in these times. So that is a really positive thing every day.
I'm pleased to hear that. We also do this in UK, but our time is 8 p.m. and our whole neighborhood like whistles and claps, and it's beautiful. It just gives this energy, and if we understand that we're all together in this. Absolutely. So before we go into the conversation about the potential implications of the recent events and what it means for the private clients and wealth management world, maybe you could give us a quick rundown of your background. You did a whole bunch of things, and then we could get into what Robbins Advising is.
Okay, I'm happy to do that. I as you mentioned earlier, I did my graduate work at Oxford University in the management school with a focus on finance. I did a lot of work on Russia and Eastern Europe, focusing on the financial sectors there as they were in those days. I don't want to date myself, but becoming market economies. And then I embarked on a career which has been fascinating, working initially for Citigroup, doing global emerging markets in the corporate bank, doing private banking, then spending some years in New York, taking a break in some ways from wealth management, teaching at the Stern School, which was a fabulous thing to do, and doing some other consulting, advising, and M&A work. And then back in Geneva, working for UBP, as you mentioned, building out a Russian East European business, including opening up an office in Moscow. And then 3 years later, being with UBS, where I led the Russian business in Russia, living in Moscow and building a very interesting business. At the end of that, I made a decision to switch my focus to being more of an entrepreneur. And so I left the banks. And since that time, I do a lot of different work with clients, families. I get involved with certain companies, with boards, and I do a lot of work with startups, including training and coaching and working with founders. And so I enjoy it. And I have to say, I really enjoy the variety and I enjoy helping people. So what makes me very happy these days is being able to help clients with different situations and find solutions to problems. That's my daily pleasure.
Understood. So I want to get into conversation around, you have a lot of experience in the financial world. You have worked, as you mentioned, you have worked as an advisor to a number of high-profile corporations and financial institutions. And you mentioned this quote of Winston Churchill on your website, a pessimist sees the difficulty in every opportunity, and an optimist sees an opportunity in every difficulty. So let's discuss how you experienced the COVID-19 pandemic effect on yourself and bring it to the present day, discussing your thoughts on what do you think it means for the wealth management world.
Wow. Okay. Well, it's a very big question. I like Churchill's quote very much. You know, I think that problems do present opportunities. I think that we can always, through the problems we encounter, we can find new solutions and new ways to do things. I mean, COVID, look, I mean, first things first, there's nothing nice about what's happening. It's a tragedy of absolutely epic proportions. And anybody who thinks it's a good thing or is bringing opportunity is misguided. So nobody wanted this, nobody invited this, but here we are. So I think in terms of how you cope with it, I think you have to do a number of things. So people that depend on you, you have to be there for them. Yeah, you have. So in my case, you know, I have my wife, I have my 3 millennial daughters. You know, I have my broader family, some in New York right now, which is a difficult time there. So you have to be there and you have to be present for them and you have to be a voice of calm and reason. Secondly, you need to be there for your clients, people who depend on you, who look to you for advice. So I have spent a lot of time trying to make sure that my clients are okay. I think maybe later we'll get into a conversation about what that means, but I've come up with checklists and ways to do a kind of survey and make sure people are okay. So I think your clients, colleagues, you know, being in touch with people and making sure people are doing okay, trying to offer solutions. Some of the things I'll talk about today, I'm happy to share with everybody that's listening because we need to help each other. It's not a time to be proprietary about things. It's a time to share and a time to help one another. And then thirdly, I think, you know, we need to learn, we need to process, and we need to share. And so every insight that we can offer people is super important today. People are overwhelmed, be they people trying to follow the markets and invest or just people trying to live their lives. The 24/7 news cycle is overwhelming. The news is from heartbreaking to tragic to frightening. And so I think those people that can somehow offer insight, I think we need to do that. And I think we need to learn from others. I've been really pleased to look at what TED has done with a great series, enjoyed listening to Bill Gates and Ray Dalio and others. And there have been a few other broadcasts that have brought a lot of value to me, and I'm sure many, many others. So that's a little bit how I see this. And then trying to stay safe, trying to, you know, to distance as much for our fellow friends and citizens as for ourselves, because we're all in it together. And if we all distance and we see it, curves flatten and we're healthier and we're better off. So all of those things. So it makes it for a full day.
That's why we're doing it, is just we thought that it's a great opportunity to connect with our network and share some of the thoughts of the clever people that we have in our network. And I'm just looking forward to this podcast, to this first podcast, and thank you for agreeing to be here. So
my pleasure.
I understand that every economic crisis is unique in its own way, but if we go back in the history, was there anything similar in the history that is happening right now?
Well, it's a great question, and the answer is as to a lot of questions is yes and no. So yes, there have been major crises. So we have every 10 years or so, the business cycle is such that we have recessions, we have dips, we have problems. But in terms of major crises, we have the 1930 depression, we have 9/11, we have 2008. So in recent times, we have a couple to really look at. And by the way, Ray Dalio spent about an hour on this the other day on TED. So for those that really want to go into detail, listen to what he has to say. But what I would say is the following. I think today's crisis is different, however, in a couple of important ways. You know, number one, we are, I think, to use a metaphor, I think we are in an induced coma in terms of our economies. We've basically taken the economies and put them into a partial coma, meaning we've shut down certain operations and certain ways of doing things for the good of the economies in the long term as a patient who's been through a trauma, right? And so I think we just have to accept that. And so I think that is unique. I can't think of a crisis where we actively did that, where we disabled parts of the economy, told people to stay at home, and effectively stopped economic activity for a greater good, of course. So that part, I think, is pretty unique. I think the other part that is pretty unique is that we, at least in our lifetimes, have not confronted a pandemic that is so widespread and so difficult to predict where it will go. And so it's a moving target. And I think that makes this more difficult because we don't know what tomorrow will bring. Now, to go back to your question, there are parallels in history that help us a lot. So what did we learn in 1930 and in the recent crisis? We learned that there is a way to stabilize the economy, that governments through fiscal measures, that central banks can step in and make a difference. And I think that, and they've done it on unprecedented proportions. So the levels of the stimulus that's being offered at national levels is pretty much unprecedented. So that we know how to do. Central banks know how to provide liquidity. They did that very well in 1930. They did it very well in 2008. So there are some lessons from the past that we can take away, I think, that are very valuable. But I do think those two first points of being in this induced coma, as it were, metaphorically, and having all the uncertainty of what is going to come from this, because a lot of things we just don't know, makes it different and difficult to manage.
I like your comparison to an induced coma, because the main difficulty with induced coma is bringing back to life. You never know, you don't know if you will be. So that's my second question. As more countries go into lockdown, the belief that the consequences of the lockdown will disappear tomorrow slowly fades away. Even if we're able to find a vaccine, medicine, or some efficient measure to combat the pandemic, it still feels that the consequences that are happening right now, it will take a very long time to dismantle them. So do you believe in a V-shaped recovery, that it can still take place?
Wouldn't that be great? No, I don't believe that will be what happens, actually. Look, there's a lot of debate about whether the recovery will be V-shaped, whether it will be U-shaped, whether it will be, which would be unfortunate, L-shaped, and the time it will take. So let me offer two concepts here that I think would help us maybe understand this a little bit better, because we all have just too much news on this. The first concept is, and you had asked me earlier about whether we have more clarity today or less clarity today on what's happening. And again, the answer is a bit of both. We, in absolute terms, know more today than we did a week ago, for sure. We know about curves flattening. We see results. We know more about efforts to create a vaccine, which is somewhere off. We know more about testing plans. Yeah, we know. So there's a lot of things that we know more about. We know more about stimulus packages. So I think, however, as we go down that path, we realize that there's so many other things we don't know about, and the timing. So the way it occurred to me in my mind is, it's a bit, if you look at it as a numerator and a denominator, and if you do that, it explains a lot of things. So the numerator is growing. We are learning more, right? So from last week, if we started out with a numerator of 1, we're now at 3 or 5. If the denominator was 10, maybe it's now 20. And so this is the challenge, that the more we learn, the more we can feel comfortable, but then suddenly we realize the denominator is growing. And the greater that this fraction reduces, right? So the greater the denominator grows, the more we're worried. And I think that, ultimately, if you want to look at happy days ahead, at some point, that has to converge on 1, right? Meaning the numerator, we start to know all that we need to know, and we start to have some certainty that the denominator matches that. And that's what we would consider getting back to some sort of normal situation, right? Whatever that's going to look like. It won't look like yesterday, but it'll be more normal. Okay, so that's the first way I like to look at this. And I think that helps explain things. And I think the second thing is I have myself broken this into 3 phases to understand how we get back to fully recovered, if you want to call it that. And I think these phases are governed by the health situation, which varies country to country. I think that has to be at the top. And I've created a matrix about this. I'm happy to share it with anybody that's interested. And the first phase, which we're in today, is phase 1, where we are still seeing curves flatten in terms of incidence rates, where we're still trying to develop tests, where we're still seeing outbreaks. So this is a difficult phase where we're not quite through. It's the toughest phase. It's uncertain, and it looks like it will go on, in my estimation, towards June, July for many countries. Every country will be different. Austria is opening next week. Germany may open again soon, and hopefully many more, but it will vary by country. But this phase, and what's also important about this phase is, and this is what I've done in this matrix, is it then corresponds to what the governments are doing with stimulus, because for the moment, it is relief and it's maintenance of the economic situation. Right? That is the priority. Providing liquidity, providing funds to citizens to be able to support themselves and live their lives, and to keep the system from collapsing. The central bank providing tremendous liquidity. Phase 2, which I hope will start in the summer, looks a little bit different. I think phase 2 will be when testing is really starting to work, where we can do genuine antibody testing and where we can have some level of confidence to reopen properly the economies. Without that information, frankly, we're somewhat blind in reopening our economies, and we can only do it partially and with risk. So as we can test and as we can know who has antibodies, as we see what part of the population is immune, having either had it or having proper antibodies, we can much more confidently deploy resources again. The third phase is where there is a vaccine. And the vaccine really is the moment at which we can say we can go back to normal without fear. That doesn't mean we won't still have problems to sort out. It doesn't mean there won't be pandemics in the future that we have to start preparing for. It doesn't mean that there will not be a lot of things to feel very sorry and sad about over the period between now and then. But that is the point at which we can get back to normal. We could have a separate discussion of what that normal looks like, because things will change, right? We will do things differently, but we will all be back to work. We will be able to travel and so on and so forth. So I think you have to look at those 3 phases. And if you understand what phase you're in, and if you understand what information you have, that then flows through, and you can make a lot of projections and understandings about what's happening in the economy, what are people doing, where is consumption, where is investment. And so I find this framework very helpful to process kind of the information.
Right. For anyone who will be interested, we will be posting this framework in the description of the video or the audio that you are listening, so you will be able to download to see what we're talking about here. So let's take our discussion toward stock market and margin calls that the worldwide panic brought to clients' portfolios. And we
Yes.
kind of discussed it a little bit over the email prior to the podcast. So I want to get your thoughts on this. Just in the beginning of this week, Citi's Robert Buckland said that the lockdown in the response to the coronavirus pandemic may lead to a 50% drop in earnings, and stock markets could follow up the same amount, reflecting the likely profit decline. So we already seen a really big panic sell-off and a lot of margin calls triggered. But in the light of this, do you think we bottomed yet, or more is yet to come?
If I knew the answer precisely to that, I'd probably not be on the podcast. I'd probably be trading right now. But my general feeling is that I don't think we've reached the bottom. I think we could drop lower depending on the news. Going back to what I said, if that denominator starts to widen, people's confidence will get lower and people will sell. I think you have to look at it in a few different ways. You know, the other day I read an op-ed piece by Robert Shiller in the New York Times. Robert Shiller has a Nobel Prize in economics and is very schooled in markets. And his basic read on the market was, you know, it looks like a lot of emotion is driving it. I wouldn't get too worked up over it. Stocks are cheaper now than they were a few months ago, and long-term investing is probably a good thing. And you know what? I think, you know, that's pretty reasonably good advice. So if you look at, you know, what's happened over the last months, obviously when the pandemic started, there were massive sell-offs, and there were different reasons for that. Part of it was this denominator spreading out and people feeling like they just don't know what's going on and scared. Two, as you rightly say, there were a lot of margin calls. Because money has been pretty cheap the last few years. Clients are in a lot of cases extended, and all of a sudden, all of this came to a head. And so margin calls were made, positions were covered, and that obviously contributed to some of the down selling, and that brought the markets down. So there were some technical corrections in there, as it were. Going to the present, I think that the markets have already, to go to the comment that you introduced the question with, look, earnings will be down by design. There's no surprise in that. So it's not a projection that earnings will be down. We know that. And that information is obviously filtered somehow into the projections. I think the projections for the markets are based on the idea that, to go back to what I said earlier, we can move from phase one to phase two. I think if we can successfully transition to phase two by the summer for most countries, then the markets will have a sense that things are getting back to normal, okay? Some business will clearly be lost, but we will move forward. I think an important concept here that people need to understand is when you have this so-called induced coma with the economy, right? You basically have to keep it going, right? And as I mentioned, the central bank provides liquidity, the government provides funds to individuals and to companies, and so on. So what we have to remember is that during the period of this shutdown and lockdown, revenue will be lost by design. Now, some of it will come back. And a very interesting analysis, a former colleague of mine at UBS, Paul Donovan, who's the chief economist for the wealth management, very, very bright guy, did a really useful analysis looking at consumption. And so if you look at consumption in this process, some percentage of consumption, he estimated about 60%, carries on. So rents, food, basic necessities,
okay,
and so on. That's not lost, that goes on. Then there's about 15% or so that is deferred. So if you wanted to buy a television today and you can't because everything's closed and you don't want to buy it online, you wait and you'll buy it. You'll buy it maybe in the summer. So some consumption is postponed, not lost, but some consumption is absolutely lost, right? And he estimated that about 25% of the economy. So there you have restaurants, you have travel. If you didn't eat in a restaurant yesterday, you can't make it up by eating there next week. So all of that is lost. So I think that's one important thing to keep in mind, is that we understand that some of that will be lost. The real question is, how quickly will it come back? How quickly will people buy those televisions they didn't buy before? How quickly will people return to restaurants, and so on? So that's one really important part of the story. The second part of the story is employment and incomes, because different countries have taken different approaches to the massive job losses that are happening. In the US, they're treated as unemployment and they're treated as lost jobs. In Europe, they're not, because it's a different approach. And so they're treated as furloughs. The work remains. The government essentially gives companies money to pay people. Which approach is better is a matter of opinion. I personally think the European approach is better, because it will be harder for people to re-enter the workforce when the economy begins to start up. We shall see. I hope I'm wrong, at least on that point. But that will be the second big question: is how quickly employment can be reset up and people can get back to work, and the many, many millions who have sadly lost their jobs, how quickly they can come back in. Because if they can't reintegrate, then consumption cannot go back up and the economy cannot get going. My gut feeling on this is a simple one, which is that things will take longer than we think initially and then happen quicker than we think. So I think that, as a lot of things, if you study corporate bankruptcies, they go on for a long time, much longer, and then they happen, and it happens suddenly. So I think it's going to happen also in the economy. I think that people, at least anecdotally, when I talk to friends and people, I don't get a feeling that if the economy is open tomorrow, everybody will rush into restaurants and rush into shopping malls and rush into events. I think it will be a gradual process, and that includes travel. So I think it will take time. This is a big question. How quickly will people readapt? Will they be cautious? And then I think at a certain moment, it will click. It will click sometime in the second phase and start to pick up again. People in some ways have short memories. After 9/11, for those of us that remember 9/11, it seemed like the world would never come back to normal, and it did. And in many ways. And so I think the same thing will apply here, although I do think we're being overly optimistic by thinking that these economies can click into gear overnight. There are so many businesses that have been closed, restaurants closed, other businesses closed. You don't flip a switch and open them back up. So either from the supply side, from opening and the establishment and actually running the business, or the demand side of getting customers back in the doors. So I think that is in. But to go back to the point, I think markets have discounted this in. I think this is understood. I think the thing that will disrupt markets the most is if the phases are pushed out for health reasons. I go back to this over and over. I think some of the things we have some control over, we have no control or little control over how this virus will spread and how quickly we can come up with vaccines. We have a lot less control. So I think, and that's why my matrix has that in bold at the top, and then everything flows from that. So that's a little bit of an explanation. I think for the purpose of investors and for the purpose of our business, the wealth management business, look, I think, we have an obligation to try to make sure clients are diversified, that they have allocations according to their needs, that they have liquidity to live their lives. And, it's all in this checklist that I put together. But I think that, there are a number of factors and that are not focused around whether the market went up or down today, but focused on the bigger picture and the longer term needs of clients. So I think the stock market is one piece of it. There's a whole debt market out there that offers different opportunities. Corporate debt, which yields had come massively down over the years, are now spiking again. So for those that want to get into debt investments, there are opportunities. I mean, UBS, for example, is recommending that there are good opportunities in corporate debt at the moment because it's undervalued compared to where it can get to. Just as an example, that was not a promotion for UBS or for what they're recommending, but yeah.
Yep. No, just wanted to point out, none of everything we discussed in this podcast is financial advice. It will be in the disclaimer of the podcast in the beginning as well. Also, you make sure if you work with private clients, make sure you check out the checklist that Greg put together. It's really simple to follow, and it's just very thorough. You covered a lot of the important things there. And
Thank
speaking
you.
of,
Thank you, Vadim. Let me just say, sorry.
mhm.
It's really meant to be simple. So it's one page. And, I think that, people who work in some capacity with clients, and some of them I know are listening to this, I hope are listening to this. I think we have an obligation to protect them in terms of markets, but also in terms of other things. So you mentioned margin calls. So there was a very bad period in March where margin calls were all over the place. And I saw situations that were not handled all that well for clients. Okay. So normally, in normal times, margin calls occur. Normally, they're dealt with in a simple way between the banker or the advisor or whoever it is and the bank and the credit department. And they're normally negotiated. It's normally, not always, but often amicable. What's happened in this pandemic is it has often gone badly, and communication has gone badly for two reasons. One, the banks have felt under tremendous risk, um, broad risk, because portfolios across the board are under pressure. And two, because there's a limited amount of time to deal with individual cases. Yeah, so they're not getting addressed well. So I really urge everybody, if and that period has passed a bit. The markets have come back, and a lot of the margin. So it's a bit beyond that, but it is a really important responsibility we have to make sure that clients are protected. So I just wanted to say that, and that's again in this list along with other points.
Thank you, Greg. Speaking of
Pleasure.
clients,
Yes.
I don't know if you're comfortable speaking about this, but considering the lot of stress that and a lot of assets going down, were there any particular requests from your clients in regards to their portfolio changes? Maybe they want to diversify towards maybe like gold, which is often used to against inflation. Like, were
Yeah.
there any particular requests?
No, I wouldn't say it in those terms. No, I would say that the requests were really what's going on. Am I well positioned? Is there something I should change? And in general, a lot of the advice I've given is not to make major changes. Again, if a client is well diversified, that is the best protection you have. The best protection is not timing the markets. It's not trying to find short-term asset classes to park money. The best defense is to be well diversified. So if you're well diversified, and if you've managed things in such a way that you're not under pressure, meaning you're not leveraged to the point where you have to sell assets, then your best bet is to wait. Markets will come back if you can wait. Some people can't. Yeah, but so those have been more, I would say, the requests that I've gotten, and I've had some people get in touch with me about margin situations because those, as I mentioned, can be not so nice. But it's also a time, and it's not my expertise, but I work with partners that are in law and other areas to look at things like obviously wills, wealth planning structures, trusts, medical proxies, succession planning. These are all the things that we always need to think about, but in today's terms, we certainly need to think about. So again, it's on the list. It's not what I do myself, but I think as advisors to clients, we need to be aware of the needs and who can help our clients with their needs.
Got it.
Good.
So there's a lot of speculation about an upcoming significant economic change, and I think we slightly touched upon it. So from monetary policy to central bank funded fiscal expansion, even Peter Schiff talked about how the Fed printing money machine will lead to a high inflation or an unsustainable dollar, calling US to go back to the US pegged exchange rate. What do you think about this statement? Do you expect significant USD inflation to occur?
No, I mean, I don't expect inflation anytime soon. We haven't dealt with inflation in a very long time. If anything, we have deflation coming out of this. Demand is so pushed down and so subdued that it will take, I mean, inflation, if we go back to economics 101, is too much money chasing too few goods. And so I think that demand will eventually come back. I think that for the moment, it's just a matter of stabilizing things. So inflation is not my biggest worry. I think the worry is what will be done later, where this money will go, how it will be used principally by corporates, by banks, because their mistakes have been made historically. In 2008, 2008 was a big stimulus plan effectively for banks, right? The real underlying thing was to help recapitalize banks through central bank, essentially free lending, right? So banks got money for free. A lot of it they lent back to treasuries, and they made a margin, and it recapitalized them. Not enough money went to companies in that piece. Today, if you look at another aspect of 2008, there were some bailouts for certain industries. And again, some companies use that money for good purposes, and some companies use that money for not so good purposes, for share buybacks and dividend payments and so on. And today, I think those lessons have been learned, certainly by the government. So if you look at the stimulus packages, there's a lot more attention paid to what terms the money comes under, whether it leads to equity stakes on behalf of the governments that provide it, and whether it can be used for buybacks, and there's a very strong view that it cannot be, and so on and so forth. So I think it's a question of what the money is used for, and that will determine how well companies come out of this. Because there's always two factors. There's liquidity, and then there's solvency. In the short term, it's liquidity. So you just want to make sure there's liquidity so people can pay bills. Solvency is a different issue. Whether there's sufficient capital and whether companies are well enough capitalized to fully recover is not clear yet. And the ones that have invested well over the years will be in a better position to recover from this, obviously.
Speaking of investment classes, I just wanted to lightly touch upon alternative investments. Like on 30th of March, JP Morgan in alternative investment division announced that they're seeking to raise as much as 10 billion in an effort to bolster the spending power as the COVID pandemic roils the global markets. So in this period of uncertainty, where are there any assets that outperform traditional assets? Maybe any alternative assets that prove themselves as pandemic proof?
Pandemic proof, I don't know if you want to call it pandemic proof, but look, a couple of things. The first one, which always is the first one everybody talks about, is cash, right? So people say, oh, just sell out everything and go into cash. That is not ideal. Over time, cash is the worst investment because it's basically earns nothing and you're taxed on it every year through inflation. Ray Dalio can explain that much more eloquently than I can, but that's essentially cash. The second is, the hedge fund space. Of course, hedge funds were by design meant to generate absolute returns and be, to not follow the markets. And in that space, there are some examples of people that have been, we could say, clever, so Bill Ackman is one at Pershing, which got a lot of attention. He bought credit default swaps to hedge the portfolio. In the end, it was successful. He generated about $2.5 billion from those, which he plowed back in, which is important, back into his core holdings. So he's now long again in the market. And again, that's one example. That could have gone very wrong. In the end, it cost him $27 million for the hedging. But on bad days, it went up as high as $800 million. So he could have lost a lot. In the end, it turned out well. Paul Singer at Elliott, similar thing, did some hedging and protected. So yes, there are examples of some hedge funds that have done well. Ray Dalio, by the way, as the biggest hedge fund in the world, did not call it right. And he'll be the first to say, and he lost 20% in March. He was down 20%. So hard to say in general terms. There are specific managers that have done okay. But again, I go back to what I said earlier. It's about diversification. It's very hard to pick which asset class or which specific investment and for what period of time in the midst of a pandemic. So diversify, and that's your best weatherproof strategy, I would say.
Right. Speaking of diversification and the real estate that you mentioned,
yes,
with more than half of the staff of real estate businesses being sent to furlough, at least in the United Kingdom,
yes.
Sales are going down, viewings are seized altogether. So you can't rent a property right now. You can't really buy. You can, but it's really hard, and nobody is doing that. So how do you see coronavirus affecting the property market, and what are the potential implications for the real estate in short and long term if restrictions will not be lifted until June 2020?
Okay. Well, it's a good question. Again, I think it will vary somewhat country to country, but in general, the biggest risk for the property market is default, right? So default in retail and or commercial, and that is not clear what the level of defaults will be. So in certain countries, the governments have put moratoriums on rental payments. It is not clear when those will be lifted, what funds will have to be returned, whether the governments will help in any cases. But it's important to understand there are knock-on effects. In many cases, landlords have mortgages to pay. If they don't get rental income, there's a cycle that is created that is unhealthy. So I think fundamentally, the defaults depend on two things. They depend on the length of time that this takes. So back to the phases, if we can successfully get to a place where people are back to work, people, to go to your point, can go look at properties and rent properties, because if everybody is isolating at home, they can't do anything. So how quickly we can move into that next phase, and what the government approach will be to rental payments, moratoriums, and so on. The commercial space, so far, office space seems to be okay, but that again will depend on the timing. But retail will be hit very, very hard, very hard, for a couple of reasons. One, because businesses will not be able to get back up and running, as I mentioned, and so that will free up a lot of space. And secondly, because of what we both talked about, this secular trend to online business over time. Which was already happening, by the way, so it's not a new trend, okay? So I think we have to just watch the space. We have to hope that, the next phases can kick in and we can get back to some sort of a more normal place. What I will say as an aside, for those listening that have real estate investments or work with advisors that are invested in real estate, it's an important time to review and to try to understand where you are. Again, you mentioned earlier, I work closely with a firm here called Global Gate Capital. I think they do a great job. And they have a large real estate portfolio, and the approach has been to do a bottoms-up review, tenant by tenant, to basically figure out what the risks are. And there's no other way around it, because at the top down, there's what the governments do and so on, and what the macroeconomic situation does, but then there's the bottoms up, and you can't avoid that. So anybody out there that is invested in real estate needs to make that analysis and look at, what properties do you have? If they're commercial properties, who's staying in them, and what are the risks there? And just to say, the analysis today of the corporate market is very complicated. It harkens back a little bit to 2008, because there's so much interconnectedness between companies. So you may look at one company that's either a tenant or a company you invest in and decide that that company is solid and that company is sound. but it may be that they have suppliers or they have clients that are not. And so even if they are sound and their balance sheet is in good shape and their business proposition works, they may get hit with external forces that disrupt their business and go against their viability. Yeah. So I think that's why, and again, if this is clients that have businesses, I mentioned this in the checklist, it's important to do a review of suppliers and supply chains, because in very strange ways, supply chains that these days tend to be more international, if not global, can be easily disrupted. If there's claims on assets, you can have patents that wind up in bankruptcy courts and frozen, and then suddenly products cannot be produced. So I think it's very important, and a very sad example of that is the production of ventilators globally, where we've learned how complicated it is to get parts in the midst of a pandemic from different locations based on different scenarios. So I think we need to really be cognizant of those things and do a proper analysis.
I actually seen, maybe you've seen that as well. It was all over the news how Tesla is using its parts from its cars to build these ventilators.
Yes.
The engineers, they like put the team to work on this, and it's amazing just to see this reaction and how businesses are trying to help. Like GM will be putting all their resources towards manufacturing as well. It's excellent to see this response.
Yes, I could only agree.
But this happens in the West. Speaking about Russia, there's been a lot of weird, uncertain news coming from Russia. First of all, they denied that they have it. Now they kind of accepted it, and they put in place, like, if for one day they put in place this quarantine to the level that people would be stopped on the streets and ask why they're there, and then find. And there's been a lot of cases, even my friends reported it, that people with megaphones go around and tell people to stay at home. Now they're going towards giving people QR codes, which they will scan to see how many times you've been outside. So while the worldwide, the debt markets around the world strengthening, and dollar dealt a devastating blow to the Russian gold and foreign exchange reserves, and they also went into this oil price war. How do you see the Russian economy responding to this? Do they think they will be able to cope with a double crisis of coronavirus and oil price wars?
Well, you've set the stage very well, Vadim, and I think President Putin and everybody else has been very surprised this year because Russia had quite a good year last year. Markets were amongst the best performing in the world. The economy looked strong. And by all accounts, you would have said Russia was in a great place to deal with a pandemic, right? And part of that was, oddly enough, thanks to the last few years of sanctions, because during the time of sanctions, a few things happened. Import substitution happened, and Russia built its manufacturing base domestically in a very positive way. 2, companies deleveraged by necessity, so debt levels are much lower. 3, Russia, as you said, built tremendous reserves, very strong reserves. And so it looked, by all accounts, like Russia was in a great position. The problem, though, is one, and you're right, for whatever reasons, Russia was slow to acknowledge the problem. Secondly, slow to react to the problem. They're not the only ones, by the way. So other countries have had this as well. And then the reaction initially was quite light. So initially, as you know, President Putin announced a national holiday for the month of April, which companies would pay for, and then allocated not a great deal of money to this issue. Sobyanin, like a lot of mayors and governors around the world, it's happening in the U.S., has taken a big role and become a big face of this in Moscow. But my understanding is about 1 to 2% of the budget or the GDP has been allocated to this issue. which is a lot less than other countries. If I look at, is that the right amount? Two people who I have a lot of respect for, Alexei Kudrin said it should be about 7%, and Sergei Guriev said it should be about 10%. So I don't know which of those numbers are somewhere in between, but it's certainly not 1 or 2%, right? So I think over time, Russia will have to allocate more funds to this because Russia does not have different laws of gravity from other countries. The virus will spread and it will have to be contained and it will take funds. Now, the question is why the delay? Leaving aside certain kind of more conspiracy theories about Putin's motives in having this delay, one could just simply say that the oil price and the uncertainty around the oil price have led to caution in terms of allocating resources there. Russia, for some years now, has maintained very strong macro measures and maybe did not want to disrupt that so much before there was a clear picture of the oil price. That would be a kind way of looking at it. If that is the case, we still don't know because we don't know yet where the oil price will wind up. I mean, as people are aware, Putin had a meeting yesterday with MBS or a discussion, and Trump is involved in this, and there is some accommodation, it looks like, within OPEC. Notably, it looks like Mexico is not in agreement and may leave OPEC. And it also looks like the agreement overall of about 10 million barrels a day did not make markets happy. People were hoping for a bigger concession to get the oil price up. The one thing that is not negotiable and can be projected reasonably well is demand for oil, because demand has plummeted. And it is unlikely to come back to previous levels anytime soon. So, there is no mistaking that 10% cuts in oil supply are lower than the cuts that have been taken in demand, which are many times that, right? And that's just an unavoidable fact. And maybe it's an inconvenient fact, but somehow over time, that will have to adjust. So to bring it back to your question, I think from Putin's vantage point today, he has to, in parallel, try to measure what are the risks on the side of oil, which does in the end supply more than 50% of the GDP to Russia. And secondly, what are the risks associated with delaying investments related to COVID-19 and to precautions and to support in that area. And I think hopefully, I hope that we'll get some clarity on the oil price soon. When I say the oil price, I mean the deal that's made. The oil price will be what the oil price is in the market, but and then leads to more resources being put against this in Russia, because Russia is a country that I love, that I've lived in, that I have many friends there, as does my wife, and so we wish nothing but good preparation there and the saving of lives and the preservation of health.
Yeah, it will be a very difficult time for Russia and Putin himself, because I think it can open a great opportunity for him to, because he's been losing trust of people for the last for a long time, and especially in the last few years. And if he would just copy measures of the at least furlough, what they're doing here, is I think people would have so much respect for him for treating them like this, and it could provide this boost. But considering the fact that the oil price is below $30 and the current budget being calculated with the 35% dollars oil price, I'm probably thinking that they might not have enough money. So it will be interesting to see how this develops, because right now, I don't really follow many developing countries apart from Russia, but right now I see clarity in Italy, I see clarity in North Korea, in UK, some sort of clarity, like Switzerland as well. my family lives in Switzerland, so they like everything is working there to some extent. Like my sister is taking her school, or everything online, everything works. Whereas in Russia, nothing seems to be working really well. Like they didn't seem to be
Hmm.
prepared. So it will be. It's one of the biggest uncertainty points on the map for me right now.
Yeah, I mean, I have to say, I do have friends there. I have friends who were treated there and who have had good treatment and who have done okay. Um, and yes, I mean, I want the same thing. I mean, in the end, I think what one has to understand is when you say Italy or Switzerland, all the countries are doing what they can to meet this. Some are better prepared than others, either in organizational terms or financial terms. If you compare Germany to Italy, um, you see a stark difference there. German finances, German preparation. Germany will be in a better position to rebound and to put injections into companies and to support companies than Italy will be. At the same time, there'll be big disagreements within the EU over finances going forward. It's already beginning with Italy and the Netherlands in terms of how we treat um, fiscal policy within the EU, which has always been a tricky subject. Yeah. And so this is a little bit going beyond the crisis. How will we all treat each other? Because some countries have access to resources. Either the US or Europe have the dollar and the euro, and they have the ability to create liquidity. They have access to funds. We haven't even talked about the developing world, which is potentially a tremendous, tremendous problem and tragedy in the making if it's not addressed. But one day, the bills will have to be paid in some way, right? And so that day is not today, and it's probably a bit down the road. But at the end of the day, we will see who are the so-called winners and losers, and how, again, how we treat each other. I think that what this crisis has brought to bear, to my mind, is looking at politics, looking at relations between people within countries, within states and cities and countries with one another, how they treat each other, and some of it has been inspiring, and some of it has been not so much inspiring. Yeah. And so, scarce resources, right? So at the end, right, in the end, we have to look at how do people address scarce resources, right? Scarce resources today, partly it's money, but it's more masks, protective equipment for health workers, tests. Yeah, that's the scarcest resource. Yeah, that often money can't even buy. And so, how is that being treated? And we see a lot of examples of bad behavior. We see countries trying to cut off supply chains, cut off orders, keep things within their borders, not allow other countries to. And I won't go into all the examples, but they're all there. Once we get back to whatever normal is, money will become a very scarce resource. Companies will be undercapitalized, people will be underwater, debt levels will be high. And I think we'll all have a reckoning of, what do we do then? And both on a national level and an international level. And I worry because globalization has been on the decline, not on the rise in terms of national sentiments, politics, and policies. And so I think this is a big question going forward, and so Russia in many ways is acting like a lot of states are acting, meaning they're looking after their own interests and not taking for granted that they can just spend whatever they want, and in the end get help from the international markets and community.
You touched upon the fact that we might see the change in terms of politics, that for example UK and US prepared and already launched several eye-watering large stimulus bills for the business and employees, and we see center-right parties call a push for greater state involvement in the economy. Even Eurosceptics in Italy have called for greater help from the EU. How do you think the new measures will change the political balance between left and right in the West?
It's a very good question. I mean, I think that in the short term, you see both behaviors. You see some very, very bad, and you see this being politicized according to people's needs. So the nationalists are saying this is exactly the evidence we need, that borders need to be closed and we need to not allow people to come into the country so easily, and we need to protect our own, and we need to not share our resources. And so if you want to use it for that argument, you can. If you want to use it for a green argument, we can use it for a green argument and say, look at all the benefits to the world. If you want to use it for a globalist argument, you can do that as well. And you can say, look at the benefits of cooperating and sharing information and supplies and so on. So you will see all of these things. Where we wind up, I think, will depend on a couple of things. I think broadly, there is a recognition that governments matter. I know I can talk for my home country, the US. If the one thing that has been so clearly learned in this crisis is that the federal government and state governments fulfill an essential purpose of protecting their citizens, right? That is the fundamental purpose of government. So anybody who says, well, what does the government do? Well, that's one of the things the government does. And so, we need strong governments in that sense that can protect us, whether it be a war, whether it be a pandemic, whether it be some other natural disaster or man-made disaster, right? So I think that's a clear lesson for everybody. Whether we become kinder societies, whether the welfare states become bigger as a result of this, big debate going on about that, and it will continue. Whether we become more globally oriented or not, again, big debate over that will continue. I think part of it will boil down to how quickly we can get out of this crisis, how these phases can work, and what the damage will be afterwards. There's, again, scarce resources following this crisis when we get back to whatever normal is, will be money, liquidity, capital, and it will be a shortage, and there will not be enough to go all around the world to everybody's needs or wants. And so I think decisions will have to be made. And so the more pain that comes out of this, the more spending and the more efforts, the more indebtedness there will be, the more suffering there will be. And I think you run a risk that people revert to themselves and they basically move inward. I hope that will not be the case. I think that would be exactly the wrong thing to take away from this. I've been saying myself since the very beginning of this that, we should have all taken more advantage of China and learned from China early on, and then gotten them involved and worked together. That hasn't happened so well. So I think that would ideally be the takeaway from this, but we're not to that point yet. And in the meantime, on a domestic level, you're seeing all kinds of political divisions in the U.S. Cities are fighting with states are fighting with each other. The federal government is fighting with states. People are not sharing equipment and knowledge. It's happening across countries, obviously. This is maybe human nature, but I don't think things should work that way. I think there's a better way. If we all work together, it's a classic prisoner's dilemma. If everybody could just work together, but they don't in the end. I hope that won't be the case in the longer term.
I hope too. Yes, it's been an exciting conversation. I think it will. We can continue for a very long time. I still have a few questions, but I think we covered the most of it, and we covered the juiciest part of it. So I'm really thankful for being able to have a conversation with you about this, and I'm really hoping that people who will listen to this will gain some insights from this. So as we mentioned, there will be checklist and phases matrix, which will be published along with this podcast in the description, which you can download for yourself. it should help you in regards to how you treat your clients, and just overall provide the sense of direction what you should do in the current state. Is there anything that you would like to mention before we end this conversation?
No, Vadim, I mean, I think you summed it up very well. I have enjoyed very much our conversation today. I've enjoyed very much sharing some ideas with people. I hope everybody who's been listening has enjoyed it as much as we seem to have. I hope that some of the materials will be helpful. It's a time we really need to walk the talk. So when I say that people need to cooperate and collaborate, I'm of the same view. So if people have questions, if people want to follow up a strain of thought, please get in touch. I imagine some contact details will be there. I'm on LinkedIn, and I'm more than happy to be in touch. And I hope, Vadim, obviously I also wish everybody to continue to stay safe and well. I hope that we move through these phases quickly and we get back to normalcy. I hope that the numerator and the denominator get back to 1. And I hope for better days ahead. And I hope that you and I can continue this conversation. Maybe we'll find other topics to talk about.
Of course, as we discussed, the main thing that we should look for right now is how fast will the testing be available for the public.
Yes.
So as soon as we move to this phase 2 or 3, I think it will be really amazing to catch up once again and see how your view has changed, how your metrics have changed.
Excellent. Excellent.
Yeah. And
I look forward, but what I look forward to more is seeing you in person at the next conference.
Yes, we hope that everything will go back to normal. Even if it's not, we'll just reschedule for a little bit later and we'll still see each other. Amazing. Thank you very much, Greg. Have a good rest of the day.
You too. Thank you.
Thank you.